G'day. Today I want to talk to you about mining towns. Many years ago, I was driving in my car and I got a call from a potential client. And he was a young fella and he says, I want to buy in a mining town. He lived in New South Wales. And I said, sure. How many properties do you own already? And he says, none. This is going to be my first property and it's going to be my first investment property. And I said, yeah, no, sorry, can't help you. Now, the reason I said that is because mining town investment is pretty volatile. If you live and work in a mining town, you get to know the area. That's a big advantage, and there's some people have made a lot of money about doing that, right? Living in there, making it from their wage, of course, but also knowing the market locally and what have you. The issue we have with mining towns is that the price of the property is a lot more aligned with commercial pricing, and by that it means that it is aligned with the rental return. So, for an example, if the property is rented at, say, $1,000 a week, well, that's going to give a price point of, say, $1 million for that property, right? Like, just pull a figure out of the hair. Now, the issue with that is that the property price is then pegged to the rent. So if the mining town sort of has a slump or goes bust or whatever, and that property price drops to, say, $100 a week, well, then all of a sudden that property is going to be worth $100,000, right? Because you would have bought it on the yield of the property. Now, those figures are completely false in terms of what's actually out there available to buy right now, but the principle is totally accurate. Whatever price you buy your property on based on the rent is the price it will always be in a mining town. So when that rental price drops, your property price drops substantially as well in exactly the same percentage as the rental price. And that's something you need to remember. I'm Scotty North, and this is 2 Minutes Tops.